If you think trading direction with options is complicated, it's really not. Long calls and long puts are the simplest way to express a bullish or a bearish opinion if you understand how they actually work. And in this video, I'm going to start out with long calls, then we're going to compare them to long puts so you know exactly when to use each trade. We'll go through the step by step guidelines that we use to structure each and every one of our trades at NetPicks. So let's go ahead and dive in. We are going to start out with the long call side. And as many of you know, you're watching this video because you are interested in options. You and every other trader. Because if we take a look at the explosive growth over the past number of years, options are really dominating every market out there. And if you go back to 2020, you can see that it has really just exploded to the upside. We're trading over 50 million contracts on a daily basis. You're in the right spot. There's a massive opportunity here. Because if I go back 20 years, you take a look at what options were traded, we were limited to monthly options, right? Then they went into weekly options. Now we're into daily options in some cases. A lot of the tech stocks have Monday, Wednesday, Friday expirations. There's just so many opportunities for us each and every week. You want to take advantage of it. Unfortunately, a lot of retail traders are trading these products incorrectly. They don't have a methodology in place. They're not basing their decisions off of numbers. And as a result, in many cases, they're not seeing the consistent results, right? They're interested in markets, they get involved, they lose money, and then they move on. You don't want to fall into that camp. What I'm going to walk you through is criteria that we know is tried and true, works in many types of market conditions, and it's really going to help stack the deck in your favor. Now, why trade long options? This is how everybody gets into options trading, right? We all love the amazing leverage that they offer. We can control a decent sized stock position with as little as a couple $100 or less by trading options. That's huge. Now you don't need a six-figure account. In many cases, you're able to get started with a few $1,000s and put on some really decent sized positions on the high flying tech stocks, the most popular names. We're not limited to trading the inexpensive stocks, the penny stocks. We want to go where the action's at. Options give us that amazing leverage. And best of all, we're able to do it with controlled risk. When I buy an option, my risk is limited to whatever I pay for that option. If I am dead wrong, I know what my max loss is right up front before I ever pull the trigger on a trade. That's important to me. In a very news driven environment like we're seeing now, you want to know what that max risk is right up front. It drastically reduces the stress level and it allows you to be way more disciplined with your trading. And I mentioned a moment ago, you can trade the hot markets, right? We all want to go where the action's at. A big mistake that retail traders make is they want to be where the action's at with a small account and they end up taking too much risk. And all of a sudden, one or two losing trades, they get wiped out. What I want to walk you through is selecting the options that are going to give you the best odds of success while keeping that risk at a manageable level. So you're not throwing all your eggs into one basket. And finally, scaling. You can start out with a small account, but I know some of you are trading with larger amounts of capital. That is great. The products that we're going to talk about here today, you're really not limited with size at all. The criteria that I'm going to walk you through can be used if you're trading one contract or you're trading 50 contracts. The criteria doesn't change. We can scale very, very easily with these products. And that's why, in our opinion, options trading is far superior to any other financial instrument out there. So let's start out with the long calls. We're going to talk about putting on an aggressive bullish position. The problem with buying shares of stock is it just requires a lot of capital. A lot of capital that a lot of retail traders don't have, right? And when I take a look at a long call option, very crucial that we do have a pretty strong bullish outlook because we have one way of making money. If I buy a call option, that call is going to increase in value as the stock moves higher. That's the only way I make money. If it does move higher, that leverage is going to reward us in a big way. It's not uncommon to see 50, 75, 100% returns in a matter of days if you get the directional move correct. Now, the P&L graph, this is why we all love trading these products. When I can take a look at unlimited profit potential with limited risk, who wouldn't love that, right? That's why we're all here. That's why I love trading these products. Now, the duration on these trades, I'm going to walk you through a couple of different approaches. We're going to talk about what we classify as swing trade and our active trades, right? There's two different approaches here, and we structure the trades slightly differently depending on your expected holding time. And I encourage you to have a mix of holding times on. Get that diversification. We all love day trading. We all love that instant gratification, but I think it's absolutely important to have that diversification in your trading, not just with the markets that you trade, but also with the durations of the options that you're trading. I have positions on that I might hold for a day. I have positions on that I hold out to 20 days, just depending on market conditions. I want the different layers of diversification. Now, when it comes to the criteria that we look for out of our trades, very simple process, but there are some very important points to make here. Number one, you have to wait for your system to produce a valid setup that fits your trade plan. Right? It could be a specific chart pattern that you're looking for. It could be an indicator that you're using. It does not matter to me what system you're using as long as you have a system in place. If you're just winging it, if you're just basing your decisions off of financial media, it's going to be difficult to follow the experts and make money consistently because you don't know the basis for their trades. You want to have a system in place. If it's an indicator based system like we use, which I'll show you in just a moment, that's great. That's going to drastically reduce that stress level. It's going to give you a rule based system that you can stay disciplined to. And once you have that in place, really important to stay disciplined to the rules. Wait for those setups, wait for the entry points to hit. Don't try to jump the gun. Don't let that fear of missing out kick in here. Stay disciplined to that rule set. And if you do need some help getting a system in place, we'd love to connect and help you with that. You can always reach out, post a comment on the video, or you can reach out info@netpicks.com and we can connect and help get you some resources there. Now, step number two, we want to trade the liquid products. Another mistake that we see retail traders making is they go to these very cheap out of the money options that just don't have a lot of liquidity. And it can make it more difficult to get fills on your trades quickly and at good pricing. A rule of thumb that we like to use with our members, with any option that you're trading, we're looking for open interest of at least 30 times the number of contracts that you're looking to trade, right? So if you're looking to trade 10 contracts, we're looking for 300 contracts of open interest at a minimum. Now, we should probably bump that number up. Again, the higher the open interest, the better. The higher the open interest, we know there's a lot of action in those options on a regular basis. That's going to make it easier for us to get in and out quickly. Step number three, make sure you have those target points and exit points in place before entering the position. Plan your trade and trade your plan. Very, very important. Again, if you don't follow this step, you're going to be left trading off of emotion and you're going to overreact to every little move back and forth. I'm going to give you a default plan that you can follow, that you can get started with. Again, very important to have those rules in place that you can trust on every single trade. Again, I say this from experience, and not only from my own personal experience, but with working with thousands of traders over the years. I see what works, I see what doesn't, I see the stumbling blocks that trip a lot of people up. One of those is basing a decision off of emotion because you don't have a plan in place. Really want to make sure you know how you're going to manage that trade before you ever put the position on. Step number four, form an opinion on how long you feel the move in the stock is going to take. All right, so this really boils back to having that system in place, right? Document every trade that you take. Know what your average holding time is. If I trade Apple, I know my average holding time on a swing trade is right around 5 days. I know that from the hundreds of trades that I've taken over the years on that product. That's going to help form an opinion on how long I feel the next trade is going to take. And that's going to help structure my trade with the best expiration cycle, with the best strike price of the option that I'm trading. Really, really important. Now, if you don't have that system in place, you can simply load up a chart of whatever product you're trading, try to go back and see how long do those directional moves tend to last. Is it 3 to 5 days? Is it 3 to 5 weeks? Start to get a feel for what's happened over the past number of months. That's really going to help structure a trade with the option that's going to give you the best odds of success based on how that product typically trades. And step number five, back test again. Load up some data, document those trades. Every decision that I make in my own trading and with our members has to be based off of numbers and statistics. There's no emotion there. It's based off of hard numbers. That's a huge advantage long-term for us. Now, based on those steps that we just talked through, now I can start to dive in and I can start to select the option that's going to allow me to produce the best profit potential with the least amount of risk. Now, we're going to talk about our swing trades here first. These are going to be, I don't even like calling them longer term positions because when you hear that, you think, yeah, I've got to hold for months at a time. It's not the case. What we're typically talking about doing here is holding anywhere from 1 to 20 days on a swing trade. Time to expiration, we like to go out 20 to 40 days. It could be a weekly option, it could be a monthly option, but by going out 20 to 40 days, it gives me a little bit of a buffer there. Remember, when I buy an option, we are fighting the time decay. Every day that passes, that option loses value. Not a deal breaker, just something I have to be aware of. As long as I get the stock moving in my favor, I'm going to be okay. By going out 20 to 40 days, the time decay is still there, but we're able to limit it somewhat versus a daily or a weekly option. The strike prices that we're going to use here, we like to go 1 to 2 strikes in the money from the entry point on our chart. Why do we like to go with the in the money options? Aren't those going to be more expensive? They are, but remember, as we start to go further in the money, we're able to limit the time decay somewhat, and we're getting what we pay for. We're getting a higher quality position. It's going to be a position that's going to better survive a little bit longer holding time. Still going to leave us with a tremendous amount of profit potential, but it helps reduce the risk. Even though I'm paying more for that option, it gives me a higher quality position that sets the numbers in my favor better than an out of the money option in this case. The out of the money options have a time and a place, which we'll talk about in just a moment. But for this type of trading with the swing positions, we're going to go 1 to 2 strikes in the money when we enter the position. And then final step here is manage the trade according to the trade plan. You've heard me talk about it a number of times. Repetition is key. I really want this point to stick in, right? You want to manage that trade following your system. If you don't have that system in place, what's going to happen? You're going to overreact to every little move back and forth, and you're just going to be stuck chasing trades in circles, and we just don't want that to happen. Now, when we go to the active trades, very similar criteria in that we have a rule-based system in place, but we are structuring these trades slightly different based on the shorter expected holding time. With an active trade, we're typically in and out in 1 to 3 days in many cases. So when I go to an active trade, if my expectation is that the market's going to remain volatile, we're going to be in and out very quickly, I'm looking for a 3 to 10 day option. That's either the current weekly option or going out the additional week. 3 to 10 days to expiration is a very aggressive position. You have to have a strong opinion that that directional move is going to happen. If it does, you're going to be rewarded for it with a really nice return. If you have any doubt at all, if the market is not active, you're in a tight range environment, I would rather go out to that swing trade, give yourself a little bit more of a buffer. The benefit to the shorter term trades, they're going to be larger returns. So when you get those directional moves in your favor, that liquidity can play out in your favor very, very quickly. I know we all love that, but be picky. There's a time and a place for the shorter term trades. There's a time and a place for the swing positions as well. I like to use a combination of both. Now, on these active trades, this is where I don't mind going slightly out of the money. They're going to be cheaper, right? With the out of the money options, they are all time decay. So we're more dependent on that directional move playing out in our favor. If it does, going to the out of the money option, if the stock moves in our favor, that out of the money option is going to move quicker versus an in the money option. You get a little bit of a benefit or a boost from the gamma picking up in our favor. And then finally, once we're in that position, we're going to manage the trade according to our trade plan, meaning as soon as the target's hit, as soon as the stop is hit on the chart, we're out of the position, taking our profit or loss, and we move on to the next trade. Let's go over to the charts and let's put this into practice, and let's take a look at an example. Bring all the pieces of the puzzle together for you here with a live example. At the time of this video, we have a long position setting up on the VIX, symbol VIX. This is the volatility product that we like to trade. And you'll notice I have some colored dots on my screen. This is the system that I use to identify both bullish and bearish trades. The whole goal of this video is to not to teach you the system. That's a topic for another day. But I want to show you I've got a system in place. And notice what happens here on the VIX. I've got my green dot right here. That's my entry point. I know where my entry point is to the penny. I have 2 target levels up above. I've got a stop down below with my white dots. Everything's mapped out for me. So now I don't get caught trading off of emotion. I'm basing my decisions off of price patterns, off of technical levels on the chart. And I have an exact entry point at 1676. And that level you can see was hit. So now I've got the green light to put on a bullish position. So that meets a number of the steps in our criteria, right? Now I can go over to the trade page. I'm just going to pull up Thinkorswim. You can do this in any broker platform. The criteria remains the same. The platforms might look slightly different, but as far as how we select the options, that does not change. Based on my analysis and based on how I know my system trades, I'm going to look for a swing trade on this position, meaning I'm going to try to go out to that 20 to 40 day window that we talked about a few moments ago. Meaning at the time of this video, we're going to go to the February monthly options that have 20 days left. That gives me a little bit of a buffer there just in case I have to stay in the trade longer than normal. I want to have a little bit of time there on my side so the time decay doesn't crush me right off the bat. Okay, so let's go out to the 20-day options. And with the stock triggering in, remember, I'm going to go slightly in the money. If I take a look at the stock price at 1635, I want to go 1 to 2 strikes in the money. If I go on the call side to the 16 strike, that gets me slightly in the money. I can also take a look at the 15.5 strike. That gets me even further in the money. How do I know which one to trade? I give a little bit of a buffer there depending on the liquidity in the options. I want to take a look at the volume and open interest. Remember, I want to have open interest of 30 times the number of contracts that I'm looking to trade. Either one of these, have that. We've got plenty of activity in these options. So it does not matter to me. In this case, there's going to be very little difference between the 15.5 strike or the 16 strike. Okay, so let's go to the 16 strike. It's going to get us in a little bit cheaper. Right now, at the time of the video, we're looking at about $2.50. $250 per contract would give me a bullish trade on VIX. I make money if the stock moves to the upside. Very typical for us to target between 50 and 75% returns on these positions. So potentially in and out in a couple of days, book my profit, move on to the next trade. Right? My risk is limited to whatever I pay for the option. If I pay $250, I can't lose any more than that $250. Now, I also promised you some trade management rules. These are some default rules. You can certainly take these. You can turn the dials, adjust them. All I ask is that if you adjust any of these rules, make sure you have some data to back it up. Don't just do it off of a hunch. Make sure that you can take a look back and say, hey, over the past dozen trades, had I stretched my target out, it would have worked and I would have made more money, right? So just make sure you've got data to back up any filter or any rule that you put into your trade plan. On the target side, we recommend starting out targeting between 50 and 75% returns on your long options. We recommend using a 50% stop. If I buy an option for $250, that's my max risk, but I only lose the entire $250 if I hold all the way up to expiration and the trade goes against me the entire time. I can always close the trade early if I need to and take a partial loss. In this case, using a 50% stop, we would take a $125 loss on the position. Not fun, but if we use proper position sizing, it's not going to wipe us out, right? We can live to fight another trade. You never want the outcome of one trade to impact your ability to take the next trade. If that's the case, you're risking too much. You're way too aggressive. We recommend risking between 2 and 5% of your account per trade. That way, if you have a losing trade, you can battle back very quickly. It's not going to wipe out the account. All right. So that's our process. Very simple, straightforward, very rules-based. We know that this approach can produce some amazing results long-term as long as you can commit to staying disciplined to the rules. As always, if you have questions, feel free to post a comment on the video, or you can reach out to us directly, info@netpicks.com. We're more than willing to help out there as well. If you found that beneficial, please subscribe to the channel. We'd love to get you some additional content here in the days and weeks ahead. If you do have any specific topics that you would like us to cover, you can always reach out there too. More than willing to put together some material that would help out as well. All right, I'm going to wrap this video up here. I'll be back with you guys shortly with our next video.
Everything discussed here is our opinion, and it is not to be taken as investment advice because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review NetPicks' full risk disclaimer and privacy policy.